Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm joined by Dan Bell from HiFX in our Never a Dull Moment Currencies Report. Welcome in, Dan.
Thank you.
Good to see you again. Look, obviously, a big day yesterday with both the Reserve Bank of New Zealand's official cash rate review and the FOMC meeting wrapping up in the US. We'll start with the Reserve Bank here in New Zealand. No change to the OCR, but they've really sort of telegraphed that there is very much likely to be a hike on March the 13th.
Yeah.
How have the currencies and everything reacted to this, and what's your outlook?
Yeah, so no change from the RBNZ yesterday, although about 35% of the market, close to 50% of the market, were expecting a rate hike yesterday. So we saw a sell-off in the New Zealand dollar after the announcement. We were trading up into the sort of high 82s against the US, and we fell all the way into the sort of mid 81s at the moment. Although the statement clearly preparing the market for a rate hike in March, and pretty much 100% of the market expect a rate hike in March. And the pricing this year, the market is expecting 125 basis points of rate hikes this year. So some pretty aggressive tightening expected from the RBNZ through 2014.
Yeah, and one of the key things, or possibly the key thing that people have been watching in New Zealand so far this year is the NZ-Aussie dollar cross rate. Now that has come off a little bit, but there was a lot of talk of parity back 2 weeks ago. What are your thoughts on that?
I think that's going to be a huge factor with the RBNZ this year. I think market pricing 125 basis points of rate hikes in New Zealand, no rate hikes expected in Australia. Their cash rate is at 2.5, so the yield differential between the Kiwi and Aussie has been a big driver of recent strength in the New Zealand dollar there. Even though we haven't had any rate hikes yet, we are obviously expecting that. To a certain extent that's priced in. The New Zealand dollar recently traded over 95 cents against the Aussie dollar. Now if you go back over the last year, the New Zealand dollar was trading under 80 cents. So it's a big rally for the Kiwi versus the Aussie dollar, and we'll be having a big impact on our manufacturing exporters. So, whilst a lot of the commodity guys, your dairy and your forestry and meat and wool and whatnot, I mean the prices are holding up pretty well there, and most of those commodities are sold in US dollars. It's really the exporters, the manufacturing exporters, the value-add exporters that are selling into Australia that are going to be impacted more by the Kiwi-Aussie cross rate. And listen, if we go 125 basis points this year, the Kiwi-Aussie could be at parity, and I think you're talking some serious damage to New Zealand's manufacturing sector that could take years to come right.
And on to the FOMC meeting. Now, obviously, they have stepped up their tapering, taking another $10 billion of bond purchases out this time, so down to $65 billion a month from $85 billion. Obviously, interest rates in the US still zero, official interest rates. Was there any surprise in what they announced?
Not really. No, I think the Fed are, they're on this tapering path, and they were flagging it last year. I mean, we expected them to taper last year, but it didn't happen. So they've reduced their bond purchases by $10 billion, and are expected to continue to reduce that by $10 billion going forward. But
every meeting, or
every meeting, I think is going to be the way it unfolds. And I think they've started. The market has reacted. The market really reacted last year, and we saw US bond yields go up significantly. But overall, investor sentiment has been reasonably buoyant. I mean, look at global equity markets. I mean, we're seeing a little bit of instability in the emerging economies, but overall, if you look at the main developed economies, we're pretty stable at the moment, and I think that's a reasonably positive sign. So I think the Fed will be quite comfortable continuing to taper. I mean, at the end of the day, interest rates, as you say, are still pretty much zero there, and they are still printing $65 billion a month. So it's going to be a gradual process. The US economy is on a reasonably strong footing at the moment. GDP growth recorded last night, showing that their economy grew by about 3.2%. So, the overall trend there is positive. Unemployment continues to come off. The last reading in employment for the last month was impacted by the extremely cold weather conditions. So, overall, I think there's a positive trend in US employment. So, I would expect to see the Fed continuing to taper, and which should continue to provide support to the US dollar against most of the major currencies.
So, where do you see the New Zealand dollar against the US by the end of the year?
Well, I think the Fed are going to have a bigger impact on the course of the Kiwi US overall. We know that the New Zealand economy is on a pretty strong footing at the moment. We know that the RBNZ are expected to raise interest rates. So those things are pretty much priced into the market. I think if we see a better outcome for the US economy over the next few months, I think you're going to see the US dollar continuing to strengthen against most major currencies. So I would say that the trend there is going to be more favourable for the US dollar. And I think even though the Kiwi US isn't going to collapse, I think at current levels around 81 to 82 cents, pretty good levels for importers. I think on the rallies, and we may well see a range between sort of 80 and 85 persist for a little while, but overall I think there's going to be more downside potential for the New Zealand dollar versus the US over the next 12 months.
So maybe down under 80 US cents?
Yeah, down under 80 cents, in due course.
Yeah.
It's a stubborn thing. I mean, last year we saw the Kiwi US down into the sort of mid to high 70s for a period of time when the Fed when the market started to expect the Fed to taper. Overall, I think a continued improvement in the US economy, a continued normalisation in the US monetary policy will see a stronger US dollar.
And the Fed has obviously had some impact on emerging economies around the world. We've got some grumpy central bankers from sort of Turkey to India, South Africa. There's impacts in Russia, Argentina as well. Rate hikes in some of those countries, big impacts on their share markets and their currencies. To what extent is the Fed really to blame for what's happening in those countries?
Well, they are and they aren't. I mean, the Fed are reducing the amount of stimulus that they're putting into the US economy and the global economy for that matter. So you've had this period of extremely low interest rates over the last few years. So investors have been investing in emerging market economies and been quite happy with the risk because they haven't had a huge amount of alternatives. Now that the Fed is starting to tighten up a little bit and the US economy is showing some strong signs of improvement, investors are questioning whether or not emerging economies are a good place to keep their funds. And you're seeing funds leaving those economies. So it's creating a flight out of those economies, which is putting pressure on their currencies. I mean, the Turkish lira, for example, had about a 10% range over the last week or so against the US dollar. Their central bank raised their official cash rate by over 2.2%, and again trying to offset the impact of a lot of funds leaving their currency. But at the end of the day, these economies continue to run extremely high levels of inflation, have significant structural problems, and obviously they need to sort those out to attract more capital. So I think the days of easy money have sort of hidden some of the issues, or at least investors haven't been haven't questioned the underlying issues in some of these emerging economies, and it's starting to come into focus.
So maybe a few chickens coming home to roost here. How big of a concern is this for the global economy, though?
I think it's being a little bit overdone. I think it's just an ongoing. It's going to be an ongoing story this year, obviously. But in terms of what the Fed are doing, I mean, this has been telegraphed for a while. We knew, last year, for example, that the Fed were going to start removing the stimulus, or at least reducing the stimulus. They're doing it in a gradual fashion, and the global economy is reasonably positive at the moment. So I think overall we're going to see these little bit of volatility in these emerging markets, but I think it's to be expected, and hopefully it doesn't get too out of hand and we have another crisis on our hands. But I think overall the main developed economies around the world are in a pretty strong place at the moment.
Thanks a lot for that, Dan. That's Dan Bell from HiFX, and I'm Gareth Vaughan at interest.co.nz with our monthly currencies report.